Do you know why Apple, one of the most valuable companies on the planet, dropped nearly 7% in a single day, while Amazon, in that same trading session, surged 12%? The answer comes down to two words: expectations and execution. Apple disappointed the market with weak guidance for the next quarter, citing supply constraints that are expected to limit production over the coming months. That caught analysts off guard because internal projections at most banks had been far more optimistic. Amazon went the opposite direction. It beat second quarter revenue expectations, driven mainly by the strength of its cloud computing division, which continues to be the company's most important growth engine. Two tech giants reporting earnings in the same week, and two completely opposite reactions from Wall Street. And honestly, that's just the tip of the iceberg of what happened in global markets over the past few days. Stick with me until the end, and I'll walk you through the full picture. Before we go on, if you want to keep up with what's happening in the global financial market every single day, quickly and without the fluff, subscribe now here on the Freedom Escape channel and hit the notification bell. We put out this kind of rundown daily, so now's the time to make sure you never miss an episode. Now let's get into the full content. This was an especially eventful week in the United States because of earnings season. Beyond the Apple-Amazon split, other companies also felt the market's unforgiving judgment. Coinbase, the largest publicly listed crypto exchange, fell 4.5% after reporting its numbers, and GoDaddy, the domain hosting and registration company, plunged nearly 11% on the same day. The pattern here is clear. The market is being extremely selective right now. Companies that beat expectations get rewarded instantly, often with double-digit jumps within hours of trading. And companies that disappoint, even slightly, get punished with the same intensity. This reflects an important shift in investor behavior. They're demanding more precision and consistency from tech companies, especially after so many months of gains driven by AI euphoria. In other words, the market is no longer giving credit just for the narrative. It wants to see hard numbers. And despite all that volatility among individual companies, the overall picture on Wall Street closed July in positive territory. In the last session of the month, the Nasdaq rose 1%, closing above 25,300 points. The S&P 500, the broadest index and the one most watched by institutional investors, advanced 0.7%, closing above 7,480 points. And the Dow Jones, the most traditional of the three, gained more than 270 points on the day. In other words, the market as a whole essentially shrugged off the individual stumbles from companies like Apple, Coinbase, and GoDaddy, and stayed confident in the uptrend that's been building throughout the year. That's an interesting behavior because it shows capital rotating between sectors and companies without losing overall confidence in the U.S. equity market. But here's the data point that really deserves your attention. And it's one that tends to fly under the radar for most people who just glance at the headlines about stocks going up or down. While tech stocks were shining, long-term U.S. Treasury yields spiked, and that's a far more structural signal than any single earnings report. The 30-year Treasury yield hit its highest level since 2007, topping 5.25%. And the 10-year note, which is the benchmark most widely used globally to price nearly every kind of asset, surpassed 4.7%, its highest level since January 2025. Why does this matter? Because when long-term yields rise at the same time stocks are rising, it's a sign that investors are demanding a bigger premium to finance U.S. debt over the long run. That's the kind of tension the market usually doesn't ignore for long, and it's worth watching closely to see whether this trend continues in the coming weeks. On the other side of the Atlantic, the London stock market also made headlines. The FTSE 100 index hit a new all-time high, breaking above 10,980 points. The rally was led by technology-focused funds, defense giant BAE Systems, and NatWest Bank, which climbed nearly 4%. This shows that optimism around technology and the defense sector isn't exclusive to the United States. It's a trend spreading across global markets. And if you think this week was only eventful abroad, Brazil made plenty of noise too. Spain's Santander announced an offer worth more than 11 billion reais to buy the roughly 10% of Santander Brasil it doesn't already control. The proposal offers a 15% premium over market price, and the result was immediate. Santander Brasil's shares jumped more than 13% in a single session. the biggest gainer on the Ibovespa that day. Interestingly, the offer came just one day after the bank posted its weakest quarterly results since late 2023. Coincidence? The market is watching closely. So that's the rundown on the global financial market today. Tech earnings moving billions of dollars in a matter of minutes. Long-term U.S. yields hitting their highest levels in nearly 2 decades. A record high in London, and a multi-billion-dollar offer in Brazil that caught the market off guard. Together, these moves paint a picture of optimism mixed with underlying tension, and that's exactly the kind of analysis that separates people who just watch the market from people who actually understand where the money is heading. If this video helped you with the news happening today, do me a big favor. Subscribe now to the Freedom Escape channel. Here, we bring you a complete, straight-to-the-point summary of the biggest stories and news in the global financial market. No filler, no jargon, just what actually matters if you want to invest with more confidence and make better decisions with your money. Drop a like on this video, turn on notifications, and let me know in the comments which of these topics you want me to dig deeper into next time. See you in the next big news straight from the global market. Take care, and until next time.